Good evening. It's April 28 and markets are pricing in the Federal Reserve's decision today, a meeting that will be overshadowed by something more immediate, a geopolitical energy crisis reshaping global asset allocation. Here is what we are tracking. The S&P 500 sits at 7,174, another record high. But beneath that headline lies a stark divergence. Value stocks are rotating upwards, while growth, particularly tech, is under pressure. WTI crude oil jumped 1.5% overnight to 97.82 per barrel. Gold is in decline, signaling a shift in investor sentiment away from safe haven positioning. This is not broad based strength, this is fragmentation. The Federal Open Market Committee meets through tomorrow, and the consensus is overwhelming. A 99.9% probability of no change in rates. The Fed will hold the target range at 3.5% to 3.75%, a third consecutive pause this year. But here is the problem they face. Inflation accelerated sharply in March. Year over year, CPI jumped from 2.4% to 3.3%, the highest reading in nearly 2 years. That's a 90 basis point move in a single month. And it is driven almost entirely by the energy shock. The Fed's options have narrowed. Oil prices at $97 make rate cuts dangerous. They would amplify inflation at precisely the moment it is resurfacing, but further tightening would suppress growth that's already showing cracks. Chair Powell is what is likely his final meeting before Kevin Warsh takes over in June. Will likely walk a middle path, acknowledge the inflation risk while maintaining a patient, data dependent stance. The real test will come in his press conference at 2:30 p.m. Eastern. Watch for how he frames the energy shock and its persistence. Let's talk about what's really driving markets today. And it's not earning through those have been solid for large cap stock. Iran, through Pakistani intermediary, has proposed reopening the Strait of Hormuz while deferring nuclear talks. But as of this morning, that strait remains at zero traffic. Oil is spiking on supply uncertainty. And this has created a structural rotation you need to understand. The Dow Jones is up on strong earning from industrial and defensive consumer stocks, but the Nasdaq is under pressure. Why? Because higher oil has two contradictory effects. One, for the economy broadly, higher energy costs compress margins, reduce real purchasing power, and threatens growth. This is deflationary for equities as a whole, particularly growth stocks priced on perpetual expansion. Two, for energy producers and capital intensive industrials, higher oil strengthens revenues, improves cash generation, and justifies valuation. It is inflationary for these sectors. So we are seeing a value rotation. Money is flowing into industrials, energy, financial sectors that benefit from inflation and away from unprofitable growth, which faces dual headwind, higher discount rates, and lower growth expectations. This is the critical insight. The S&P 500 hitting a new high mask as, as a mask, a painful reality. Under the surface, the market is hedging against stagflation. Investors are positioning for a world where inflation persists and growth slows. Exactly the scenario the Fed fears most. Globally, the picture confirms stagflation fears. Japan's central bank held rates but slashed its fiscal year 2026 GDP forecast from 1% to just 0.5%, cut in half. They are raising inflation forecast at the same time. That is stagflation in one country. The UK is worse. British retailer report a collapse in sales. A 68 balance on the CBI distributive trade index, missing consensus by 26 points, the worst reading since the pandemic. The PMI says growth is okay. Real demand says it's broken. Brazil's Copom meets today too. Oil at $97 makes their rate cut agenda nearly impossible. Oil is a major cost input. Meanwhile, the Nikkei and KOSPI hits records on rotation, not demand. There are index gains driven by the commodity exposure and market structure, not broad based economic strength. The global narrative is unified. Stagflation risk rising.